Welcome back, everyone. We're thrilled to jump into our next session. I'm Russell Burns, analyst here at Finimize, and it's a pleasure to be joined by Sheila Warren, CEO at the Project Liberty Institute, and James Butterfill, head of research at Coinshares, as unfortunately JM couldn't join us. This session, titled The Next Decade for Cryptocurrency, will run as a 30-minute facilitated fireside chat. Sheila, James, it's a pleasure to have you with us today. Welcome to the Modern Investor Summit. Okay. So first up, how do you see the evolving relationship between traditional finance and crypto impacting retail investors over the next decade? Sheila, why don't you start this one off?
Sure. Thanks, Russell. It's so great to be here. A decade is a very long time. And so what I'd start by saying is that we have seen TradFi actors be involved with digital assets and crypto for the past decade. They just weren't as public and vocal about it. So what I think we're going to see over the course of the next year, let alone decade, is just an additional number of form factors for retail investors to engage with underlying digital assets. You already have ETFs as a great example of this, and ever expanding. The Chainlink ETF, the Solana ETFs, like more and more of these, I think, will become commonplace and probably just de rigueur. You also have digital asset treasury companies and those attempts. So I think you're going to see just additional familiarity of form factors, new models and pre-existing models that will provide additional comfort and ability to engage. Now, whether that's directly or indirectly remains to be seen.
Excellent. Thanks for that. James, sort of your thoughts on this?
This is a really good question, because this is exactly what we've been writing for our 2026 Outlook, which is due to be published on the 8th of December. We are coining it hybrid finance. So that is that combination of TradFi and crypto coming together. And I think when you look back now, it kind of looks obvious. There's quite a few sort of hybrid finance things happening. And so they're moving towards that integration. You just have to look at a lot of TradFi institutions. If you think about blockchain networks, Citigroup, Santander, JP Morgan, they're all involved in it. Payment networks, again, JP Morgan, MasterCard, Visa, PayPal. You have custodians, all the big ones out there, BNY Mellon, State Street, HSBC. So a whole load of different companies are getting involved now. Crypto exchanges, well, in the UK here, we just had London Stock Exchange get involved, the NASDAQ, Deutsche Bank, Goldman's. There are so many different names. And then already, I think, without knowing it, you've seen this TradFi getting deeply involved in the crypto space through the launch of ETFs in the United States in particular. I mean, BlackRock had the most successful ETF launch ever. I think in its first year, it saw $40 billion worth of inflows into Bitcoin. That's making it the most successful ETF ever launched across any asset class. Something it took gold 30 years to do, it did in 1 year through BlackRock. And then a whole load of other people, Franklin Templeton, Fidelity, Goldman's, JP Morgan, again, it's quite a few of the sort of suspects. But what's interesting about this is it seems quite US focused, centric at the moment at least. And I do think things like the Stablecoin and Genius Act have helped massively in building up confidence for US institutions, particularly financial ones, to start getting more involved in the blockchain and crypto space.
Excellent. Okay, thanks for that. And that leads us into the next question, which is kind of how do you expect regulation, whether in the EU, US, or emerging markets, to affect innovation and retail participation in crypto, sort of, in the coming years? James, do you want to follow on from that because you were there?
Yeah, I mean, is this regulation an enabler or a hindrance? I think it's genuinely an enabler now, and that really changed when the United States, we had a few court cases a couple of years ago, about this time 2 years ago. It became very clear things were starting to change. Operation Choke Point was kind of ended after Donald Trump got into power. And we've seen a big change. I mean, even the head of the SEC now is very pro crypto. And so I genuinely think it's an enabler. Being in the crypto space for 6 years professionally now, when you hear things like FTX, it's actually hugely frustrating to hear bad actors in the space, and there being a lack of regulation. Why should an individual have instant access to 100 times leverage on their first day of trading on a crypto platform? It's probably not a good idea. So I actually really think having clear frameworks, in Europe we have the MiCA, Markets in Crypto Assets Directive, and just makes it safer for retail investors and compliant for providers. So in my view, this regulation's important, much needed, and is starting to have a very positive effect on the space.
Yeah, thanks for that. And Sheila, sort of how, if you got please sort of go ahead. Yeah, that was quite sort of extensive, but please.
Yeah, no, I have a lot to say here. I think,
Excellent.
look, I have a bit of a controversial position here. My view is that no major jurisdiction is really doing a phenomenal job here, to be honest. Each has different strengths, but there isn't really a major jurisdiction that's taken a fully comprehensive position. And I would just to go right to MiCA, because where James left it, they were the first mover. The EU was the first mover. I've been in this space for a decade looking at the policy space in addition to just innovation and technology. But implementation of MiCA is proving quite difficult. It's going to be interesting to see if that gets reopened, if there's some adjustments. Another example, Japan was very early to the table, but they're now reclassifying digital assets under financial instruments and exchange rather than payment services. So a lot of the early movers here that did land, quote, clarity are now finding implementation to be challenging because the space has evolved. At the same time, you're seeing jurisdictions, even in the US, where there's definitely an open posture and a welcoming posture of digital assets, but there are several things that have not been resolved. And some of those are more recent innovations, taxation issues around staking, things like this. There's the next generation, or the current, I would say, evolution of where digital assets are moving and going, and keeping up is quite difficult. So I think that the most important thing about regulation, there's a couple things, right? So tax treatment obviously affects retail and the willingness of retail to engage in certain kinds of form factors versus others, but also this kind of openness to what's coming next, whether it's DeFi and embracing DeFi or not embracing DeFi, whether it's taxation and new structures, all of that is going to have an impact and effect on how retail investors engage with this asset class. Now, that being said, I think, Russell, your first question is really important, because engaging with something like an ETF, for example, or even like a DAT, to the extent those persist, is a different thing. Right? When you have indirect exposure to the asset, you may find retail being very willing to engage in that form factor, but maybe not willing to be as, let's call it, cutting edge with the way that they're engaging, right, with the technology and with the asset. So all of this is to say, I think it's a bit of an open field right now. Certainly eyes are on the US as a really fast-moving leader, relatively speaking, in the space. But a lot of other folks have a lot of interest in, either catching up or landing the plane to make sure that their jurisdiction remains or becomes the place of the most growth.
Excellent, thanks for that. So, touching on the ETFs and where retail investors typically participate, James, what do you think are the most important things that retail investors should know about the risks and benefits of crypto ETPs and managed products?
Yeah, I mean, I'd say the initial thoughts is that looking at the different access routes to Bitcoin or other crypto assets, you could accuse me of talking my own book, but I do think the ETP structure, the ETF structure, is one of the better ones. Just because if you're doing self-custody, there's always a risk you might lose it. There's some technical error, you lose the underlying assets, or it gets stolen. If you go to a centralized exchange, what happens if that exchange collapses? And I think the benefit of something like an ETF in that respect, at least, is that it's a regulated instrument, and it's bankruptcy remote. So if the underlying issuer defaults, then you still have access to those assets. And I think that's a very positive thing. But I mean, I'll focus on the risks and come back to a few benefits. I mean, I think just the underlying asset, crypto, is volatile now. If you're looking at something akin to Bitcoin, at least, is something like gold, and it's nearly triple the volatility of gold at the moment, or at least double the volatility. And an ETP does not, or ETF doesn't eliminate the underlying asset price swings. There is some product design risk. Some products include fees, leverage, or synthetic components. So people must really understand the underlying, exactly how performance is tracked. There's quite a common thing with ETFs. Do they genuinely track the price of the underlying, say, Bitcoin or Ethereum accurately? That's something worth considering. And then also liquidity. how across different products that varies in the ETF world. So some smaller assets under management, smaller products financially might struggle in terms of liquidity. So I think they're the kind of key risks. But going back to some of the benefits, it is in a regulated structure, so it's something you can buy in your pension. I think it's in the US, it's a 401k, and you have that institutional grade custody. Certainly at Coinshares, we have a custody solution that's not just a sort of ledger device at home. They're these hardware security modules, and we've mirrored very sort of similar legal structures to how gold ETFs are structured. And there's an operation and simplicity, very, very familiar investment platforms that they're on. So I think there's plenty of sort of real benefits of ETFs in that respect.
Okay, good. Thanks for that. And so many ETPs, funds and structured products promise exposure to digital assets, which you kind of touched on there. But what are the trade-offs versus holding cryptocurrencies directly? And again, you touched on that a little bit. And how should investors think about counterparty risk?
Yeah, so not every ETF is the same. Futures-based products tend to have some sort of issuer risk. So if that issuer dissolves or goes bankrupt, what will happen to the underlying assets? And I think it's really important to understand that. So I'm just trying to think of other kind of key kind of issues. I mean, so I'm just going to think about this. Having full self-custody, that's risky, and in the crypto and an ETF space, you don't have self-custody. So I think that's actually a real benefit. If you do hold crypto directly, it requires personal responsibility for the wallets, the keys, and the security. So that is quite a technical ask for many people. If you start to look into it yourself, particularly in the early days of crypto, it took an awful lot of reading to understand how to do this safely. And let's say if you end up with a significant amount of money, it becomes an incredibly nerve-wracking thing doing it yourself. And in an ETF structure, all of that's handled. And also in an ETF structure, generally some sort of mistakes potentially reversible. If it's done yourself, it's ultimately irreversible.
Excellent. Thank you for that. Yeah. So, Sheila, what do you think is the most important thing an individual should do to take control of their online data?
That's a great question. I think it all comes back to, James, just picking back again where you left it, self-education. So educating yourself about what are these assets, what is it that they're doing, etc. But in terms of taking control of your data, I think it's just making sure you understand what whoever you're giving your data to is doing with it. So right now, a lot of people are just very willingly, most people, let's be real, in the interest of convenience, as we always have, are signing over tremendous amounts of information to online platforms. And this is primarily happening through AI, through LLMs, and what you're putting into whatever your ChatGPT or Gemini or Claude or whatever it is, you are actually defaulting and trusting that the information you're providing, which in some cases we know is extremely sensitive, emotional or personal or health or information you wouldn't normally give out on the street just to anybody, you're typing it into, let's say, ChatGPT, and trusting that it's being used for your benefit and not being monetized or not being shared in some way that you wouldn't consent to. The beauty, of course, of blockchain technology is that over time, as these technologies begin to intersect more and more, we're going to see more transparency in where that information is going. But right now, it's the case that you don't always really know. So it comes down to, I think we're a little bit with these LLM models, a little bit where we were, this is maybe a bit of a stretch of a parallel, but where we were in the early days of crypto wallets, where you had to really do a lot of education in order to even access the form factor. Here, it's so easy, it's so user-friendly, but you're not really given full line of sight into what's happening. So it comes down every time to just education, researching the brands you're interacting with, and just doing your own diligence.
Okay, good for that. And talking of AI and LLMs, how do you see AI impacting the adoption of crypto?
Yeah, well, again, I talk about these as intersectional technologies. The idea that any technology is operating in a full silo, I think, is a bit silly, both technically when you think about a tech stack, but also when it comes to the market. So people don't like to say this or acknowledge it, but we're certainly seeing that crypto is tracking the broader market and broader market trends. And when things go up or go down, you are seeing effects there. Crypto AI is no different. As AI begins to dominate, or already is dominating tech stock, whether it's a piece of a broader tech company's portfolio like a Google or a Meta, or whether it's an independent AI company that itself is listing stock. As you see that, we're going to see the dips and the rises and falls that are also going to track. So what I actually think is more interesting is, again, as these things start to connect, as you see crypto and blockchain technology and tokens and tokenization start to become a way of getting more transparency into AI models and what they're doing. That's one thing. I also think we're going to see commensurately the ability to use AI to educate people about the different opportunities that you can avail yourself of as a retail investor in crypto. So not everyone knows what an ETP or ETF or any of these things are. I know a lot of people are going to type that into an AI and try to figure it out. Like, what should I be doing? How do I balance my portfolio? So it'll be interesting to see how just general investment, how people begin to leverage these tools, these new tools that have come online to help them think about balancing their own portfolios, or about how to think about risk, to the other conversation that we've been having.
Excellent. Yeah, thanks for that. I definitely use them to sort of ask sometimes simple questions.
That's right. And there's no embarrassment, right? Because no one needs to know.
Maybe someone does somewhere. How do you think decentralized governance models like DAOs, protocol voting, on-chain proposals will impact financial inclusion and retail influence within crypto systems? James, do you want to start with that one?
Yeah, that's a very meaty question there. And specifically for DAOs, I would just very briefly touch on, I think, crypto generally. I think crypto is actually a very democratic thing. And it also allows the 1.7 billion people around the world that are unbanked to have a bank account for the first time, as long as they've got some sort of smart device to do it on, or access to the internet. So I think it's an incredibly important thing. And actually, I really like the concept of DAOs, where you're letting participators in the network or fractional owners in the network make decisions on various different governance things. You could perhaps argue that the Swiss referendum system is kind of similar in that respect. I think it's a very good idea. I think in practice, we've seen some challenges to this, though, in that the voter turnout for DAOs tends to be incredibly low. And I'm talking sort of 3% voter turnout. And so whilst it has the best intentions, the practical thing is not many people actually do it. And maybe it's because it's technically quite difficult to do. I mean, DAOs could really empower retail influence, but I think true inclusion requires decent user interfaces and simple ones. It requires education and proper voting power distribution, I think. And so these things can happen, but I don't think, as we look at it right now, they're quite there yet.
Okay, maybe in the decade. Go, Sheila, how about you? What do you think about this?
So I live in California, and California has had one of the most direct experiments in direct democracy, in the world. And I can tell you, as a California voter, the number of times I've been asked to vote on something where I really don't understand why I need to weigh in on this thing when I have elected a person that I'm hopeful is doing that job for me is very real. And so I approached DAOs. I was obsessed with them back in like 17 to 18 to 19 time period, maybe a little later than that. And as this opportunity, think about direct democracy, right? You have a chance to vote. Oh my gosh, you're going to like leverage that and take advantage of it and be really present and do all the things. But as James noted, 3% of voters vote, because it turns out, not unlike in California with these propositions and ballot measures, people kind of don't want to deal with it. They sort of want an elected representative to be the person. They want to trust that someone's in charge and not have to always be in charge. So the realities of direct democracy and the theory of direct democracy don't often align. And we saw that, I think, very, very well. We see that very much in DAOs. Now, all that being said, my hope and what we have seen, I do think that we've seen significant democratization and opening of finance, open finance and open markets, open banking. These are all concepts that I think crypto and digital assets ecosystem have really helped to codify and to land in ways that are not just theoretical. And certainly the hope is that decentralized governance models, whatever they wind up looking like, I think they're evolving in real time. And I think AI, by the way, is a big part of this. The ability to self-educate using AI is very, very different than it was, 10 years ago or 5 years ago even. So I think we're going to see experimentation that combines AI models and AI modeling with DAO governance, with other kinds of things. And we're going to see, I think, voting that's going to, just the way that you might put like a sell order on something, you could put a voting order on something, right? And say, if this proposal comes through and it has these parameters, I'm going to vote this way, and almost precede your vote on certain topics. That kind of thing, I think, will start to happen a little bit more, which may mean that you get more inclusion and more people participating, but we'll have to see. But the question I think you're really asking is about financial inclusion. And there I would go to the idea that the openness of these models, the more you see traditional finance start to get involved in, again, creating what I call these form factors that are more familiar to people, that feel less scary, that don't require you to custody yourself or your own keys or be all of those kinds of things, that allow you to assess risk in ways that feel more familiar to you and that are more comprehensible to the average, I'd say, retail investor. You're going to see, I think, more inclusion, because a lot of this is about willingness to participate, right? So you have to, as a retail investor, be willing to engage with the asset class. Now, here's where it goes both ways. As we see more and more, headlines go two ways, right? On the one hand, there is, okay, crypto, normal, digital assets, all these big names and big banks are getting involved with it. You're also seeing a lot of stories about shadiness or corruption or things that people don't love. So it remains to be seen how all that plays out. And it really is a jurisdiction by jurisdiction question. So I'll come back to just conclude my comments here, Russell, to your question about the global marketplace and global policy and regulation, because I do think that a signal from a government, from the key regulator in any given jurisdiction, that this is a safe asset class to engage with in whatever form factor is really important to a lot of folks. Let's remember, anyone who is a degen's already invested and already involved. We are now looking at much more normie, let's call it, folks, right, who haven't historically been engaged and really want to be engaged but don't know what to do. How do you appeal to that market and those investors is a very different question than how do you appeal to folks that 10 years ago were super excited to hold their own keys, self-custody, and have a wallet.
Excellent. Thanks for that. Okay. So moving on, what are the most misunderstood risks or overlooked opportunities that investors should focus on in the next 10 years? Go on, James, have a go at this one, yeah?
Yes, I mean, that's another meaty subject here. So I think the biggest risk is people that just dismiss crypto because of all the negative press that it gets. I think it's very, very easy to criticize it. What we have experienced is, I think, similar to the growth of the railroads in the United States 200 years ago. With it came a huge amount of malinvestment, a huge amount of misunderstanding, and a huge amount of bad actors that I think maligned what was ultimately a very good thing, building rail infrastructure for the United States. And we look back at it now and it's very important. And I think crypto is experiencing that right now. There are bad actors, there's misinformation. Some of the really, I think, big misinformations, I can pick on quite a few, like it's a criminal asset. Chainalysis and Elliptic do their Bitcoin forensics companies that look at criminal activity in the crypto space, and they can, with a fairly high degree of accuracy, pick out criminals. And they estimate around $24 billion worth of financial activity happened last year, criminal activity. That represents just 0.6% of global money laundering. So other currencies have a lot more to concern about. And I think people, if you think about recently the Hamas, a year ago with Hamas, it was funded apparently by cryptocurrencies. That represented only about 3 or 4% of the funding. The rest is oil dollars. And so it's very easy to just dismiss it and say, okay, it's a criminal asset, therefore I won't get involved. And I think the reality is quite different. Another thing is something like the environment. 56% now of Bitcoin mining is from sustainably sourced sources. It has been a massive boon to the power industry in Texas, for instance. It load balances, it improves profitability of power production companies. So much so, actually, that the reinvestment into the power network, into the Texas power, we've seen a 900% rise in solar power production over the last 5 years. So there's some real positives there. It can, we now, I think, if you look at the carbon intensity of Bitcoin, it's 250 grams of carbon per kilowatt hour, compared to the financial industry of 400 grams per kilowatt hour. So these kind of things, I think, overlook some really interesting opportunities in the space. Tokenization of real world assets, that is things like being able to own T-bills in a very simple and with incredibly fast transaction and settlement times. Those kind of things will massively benefit people. And I think a lot of these things might well happen in the background. You won't even know it. They're on the crypto payment rails. But there's plenty of benefits, a huge number of opportunities. And I do really implore people to look at I'm not trying to sell it too much, our 2026 outlook, which will be coming out in December.
I'll definitely give it a read. Sheila, do you want to have a go at that? Sort of, there's plenty there, yeah?
Yeah, I agree with almost everything that James said. I think I'll add and just say misunderstanding is definitely a key one, but I would add, maybe this is a bit of an OG philosophical thing, having been around now for these 10 years in this industry. I do worry that we're going to lose the plot. And so many of us got into the space early on, for very, you might call them lofty, you might call them naive, ideals. And this idea really was about democratization, decentralization, breakups of monopoly power, and really giving the average individual around the world, like a global citizen, access to owning their own funds, their own keys, getting access to these opportunities that had been gatekept from them for a long period of time. And you can go back to the history of redlining, whether you're talking about the United States, about de-risking and banking, right? Correspondent banks fleeing certain jurisdictions, all of this. Hypervolatility, hyperinflation, all the reasons that people in many parts of the world were not able to meaningfully access a financial ecosystem. That's really important. And so I actually think a risk is that gets lost. So while I am not averse, clearly, to TradFi engaging with these assets, I think that's really important for a variety of reasons, not just the least of which is validation or giving sophistication in some extent to the instrument. But I think it's really important to not lose the thread that brought a lot of us here in the first place and recognize that we still have these persistent problems of financial inclusion, of being underbanked in many parts of the world. And the less we focus on that problem, I think that is to the detriment of the entire industry. And frankly, shame on the industry if that doesn't become a massive priority while everyone's chasing the next high, right? The next ATH. The other thing that I think is important is this, again, I'll go back to AI. So this idea that when it comes to AI, which I will bluntly say is in a hype cycle, and I think we kind of know that, you aren't necessarily seeing profitability from some of these companies yet. But crypto, over time, particularly Bitcoin, this is an asset that, while volatile, has demonstrated very significant returns. And so again, a worry about losing the plot, whereas this is kind of in the press often denigrated as an opportunity, whereas AI, everyone run to AI because that's the thing. And I'm like, and as an investor, like, how do you think about that, right? This is something that has proven. Now you have to have a certain profile, you have to be patient, all these things. You have to be able to time the market a little bit. All those things are true. Nevertheless, over the past decade, we've seen what we've seen, okay? So I just worry that will get a little lost in some of the hype that we're in at this moment, which I think will persist for the next year or so at a minimum around AI and other, by the way, emerging not to pick on AI, other emerging technologies that will be the fad of the moment. Whereas this is now, again, it's proven itself, I think, over time, to the extent that as a retail investor, people should be paying attention.
Excellent, thanks for that. We're kind of running out of time, but maybe, James, you can quickly have literally a quick answer about cybersecurity and hacking risk. You've touched on it already. If I could ask maybe 30, 40 seconds before I quickly have to bring it to an end.
Yeah, sure. So Bitcoin's never been hacked, but the exchanges that hold Bitcoin have been. That's important. So choose your exchanges properly or correctly. Also, quantum computing, a huge subject. Most of crypto is not vulnerable to this. There's a very small bit on the elliptic curve or the early Bitcoin wallets, but recent sort of software upgrades in crypto and Bitcoin have solved these kind of problems. The rest of the financial community's got a lot more, I think, to worry about in terms of hacking risks. So what can they do? Multi-factor authentication, prefer hardware wallets for self-custody, those kind of things, beware of phishing, a whole range of different things I think I could cover off. But just be certain that Bitcoin has an incredibly high level of encryption, even quantum computing can't crack.
I'm pleased to hear that one because it had been a concern of mine. Okay, thanks so much, Sheila and James, for sharing those insights. And thank you, audience, for listening in. That brings this session to a close, but stay tuned. We'll be back shortly with more great conversations. See you soon. Thanks.